For decades, they told the world silver was just an industrial metal, boring, stable, controlled. And then it wasn't. There was no warning, no headlines first, no panic at the beginning, just a quiet break in the system. $50 disappeared. $70 meant nothing. $100 wasn't a target, it was a message. Because when silver moves like this, it is never about silver. It is about what just failed somewhere much, much deeper. And if you think this story is about profit, you're not ready for what comes next. The people who watch systems didn't celebrate when the number crossed $100. They don't celebrate. They pause, they look at each other, and they ask a simple question. What kind of world allows silver to trade at a price that should not exist? For most of modern financial history, silver lived in a narrow box. It moved up and down, but always inside limits that made sense for a stable money system. It was used in factories, in electronics, in medicine, and in small amounts as savings. It was not supposed to be a warning signal. It was not supposed to be an escape door. And yet, here it was. Above $100, not slowly climbing there, not after years of excitement, but breaking through levels as if those levels were never real to begin with. They understood something important in that moment. Markets don't move like this because of good news. They move like this when old rules stop working. Silver is different from most assets. It's not only a metal people store, it's a metal that the modern world burns every single day. Phones, solar panels, cars, data centers, medical tools, all of them consume silver. Once it's used, much of it is gone forever. This means silver is both money and a critical resource. When a system is healthy, this dual role keeps it calm. When a system is stressed, this dual role makes it explode. Gold is held, Bitcoin is held, stocks are held, but silver is used up. For years, this fact didn't matter. The price stayed low, too low, so low that many mines stopped investing, and supply growth became weak. The world started living on old stock without even noticing. At the same time, something else was growing quietly. The amount of money in the system. Not savings, not production, just money. More units, more promises, more numbers on screens. They printed to fix crises, to stop panic, to support markets. And each time it worked, for a while. But systems don't break where everyone is watching. They break in places that seem boring. The silver market was one of those places. On paper, silver was everywhere. Contracts, funds, accounts, promises. On screens, there were billions of ounces. In the real world, there were not. For a long time, nobody cared. As long as people traded the paper and didn't ask for the metal, the system looked fine. The illusion stayed strong. Then, behavior started to change. Factories wanted secure supply, not just a cheap price. Some countries wanted metal inside their borders, not promises stored abroad. Some investors stopped asking, what is the return? And started asking, will it still be there? This is how trust leaves a system, not in a single day, but in small, quiet steps. When more people ask for the real thing at the same time, paper systems don't adjust smoothly. They jump, they gap, they break. That is how $100 happened, not as a victory, not as a rally, but as a repricing. And this is where the comparison to Bitcoin matters. Bitcoin is seen as a symbol of the new age, a new kind of asset. It grew because people stopped trusting old systems and started looking for exits. But silver did something more disturbing. In a short time, the total value added to silver became larger than the entire market value of Bitcoin. This isn't a story about which asset is better. It's a story about scale. Bitcoin is optional. Silver is not. You can build a world without crypto. You cannot build a modern world without silver. So when silver absorbs more capital than Bitcoin, it's not speculation. It's not fashion. It's fear moving into something that cannot be replaced. The people who manage large systems understand what this means. They know that markets aren't just places where prices move. They are places where stress shows itself. Silver didn't break $100 because the world became richer. It broke $100 because the old prices belonged to an old world, a world where money was trusted, a world where supply chains were smooth, a world where promises were enough. That world is leaving. And silver was one of the first places where the change could no longer be hidden. This is why serious observers didn't ask, how high can it go? They asked, what had to break for this to be possible at all? Because when a small, quiet market starts sending a signal this loud, it is never the market that is the real story. The silver paper market. What is it? How does it work? And what are the risks involved? Let's get into it. First, what do we mean by paper silver? Simply put, it's any silver investment that isn't physical metal in your hand. This includes things like futures contracts, options, exchange-traded funds, or ETFs, and even unallocated silver accounts. You're essentially buying a contract or a share that represents a certain amount of silver, but you don't own the actual metal itself. Now, why does this market even exist? For a few key reasons. First, convenience. It's way easier to click a button and buy an ETF than it is to find a reputable dealer, arrange for shipping, and figure out secure storage for physical silver bars or coins. It's a very liquid market, meaning you can buy and sell your positions quickly, almost instantly during market hours. This makes it attractive for traders who want to speculate on short-term price movements without the hassle of dealing with the physical product. The paper market also allows for leverage. With futures contracts, for example, you can control a large amount of silver with a relatively small amount of capital. This can amplify your gains, but be warned, it can also amplify your losses just as easily. So it's a high-risk, high-reward game that's definitely not for everyone. This brings us to the inherent risks of the paper market. The biggest one is called counterparty risk. When you buy paper silver, you're trusting that a third party, the exchange, the fund manager, the bank, will make good on their promise. You're relying on them to actually have the silver they claim to have, or to be able to pay you the cash value of your contract. Let's talk about the big players. The COMEX, which is part of the Chicago Mercantile Exchange, is the main futures and options trading market for metals like silver. A lot of the silver price discovery, meaning how the spot price is determined, happens right here. But here's the catch. The amount of paper silver traded every single day absolutely dwarfs the amount of physical silver that is actually available for delivery. We're talking ratios of 100 to 1, sometimes even 300 to 1 or more. This creates a system of fractional reserve silver. For every 1 ounce of physical silver in a vault, there might be hundreds of paper claims on that same ounce. As long as most people are content with just trading the paper and don't ask for the actual metal, the system works just fine. The price is set by the supply and demand of these paper contracts. But what happens if a large number of investors suddenly decide they want to take physical delivery of their silver? This is where the whole system gets shaky. If everyone rushes for the exit at once, there simply isn't enough physical silver to go around. The promises made on paper can't all be fulfilled with real metal. This potential event is what many analysts refer to as a run on the vaults, or a delivery default. This leads us to the growing disconnect between the paper price and the physical price. You might see the spot price of silver quoted on your screen, which is largely determined by the paper market. However, when you go to buy a physical Silver Eagle coin or a 10-ounce bar, you'll pay a premium over that spot price. This premium is the extra cost for minting, distribution, dealer profit, and most importantly, the actual availability of the physical product. In times of high demand for physical silver, we've seen these premiums skyrocket. The spot price might be going down, but the price you pay for a coin in your hand is going up. This shows a clear disconnect. The paper market is saying one thing, but the real-world market for the physical metal is telling a completely different story. It suggests that the paper price might not be a true reflection of the value of having actual, tangible silver. So, what's the takeaway here? The paper silver market offers liquidity and convenience for traders, but it's a leveraged system built on promises, with far more claims than there is physical metal to back them up. If you're investing in silver as a long-term store of value or as a form of financial insurance, it's critical to understand this distinction. Holding physical silver eliminates that counterparty risk. As the old saying in the precious metals community goes, if you don't hold it, you don't own it. Understanding the difference between paper and physical is key to making informed decisions that align with your own investment goals. Think about why you're buying silver and choose the form that best suits your strategy. The change did not begin inside the silver market. It began far above it. For years, the global financial system had been living on borrowed time and borrowed confidence. Governments carried more debt than they could ever reasonably repay. Central banks held interest rates at levels that did not match reality. Each problem was solved by creating more money, and each solution made the next problem larger. At first, this did not look dangerous. Inflation was called temporary. Growth was called resilient. Markets were called stable. But stability built on constant intervention is not stability. It is delay. Slowly, the cost of this delay began to appear. Prices of everyday goods stayed high. Interest payments on government debt grew heavier. Trust in official numbers became weaker. This created a quiet but powerful change in behavior. Investors, institutions, and even governments stopped asking what gives the best return and started asking what will still be there. This is the kind of question that does not show up in charts, but it changes everything. Money itself began to lose its position as the final measure of value. Currencies were no longer compared only to each other. They were compared to real things: energy, food, land, metals. Silver sits in a very strange place among these things. It is not only a store of value, it is also a key input for modern technology. This means its demand does not disappear in a slowdown. In many cases, it grows. At the same time, its supply cannot respond quickly. Mining is slow. New projects take years. Ore quality has been falling. Costs have been rising. And because prices were low for a long time, investment in new supply was weak. So, when demand started to rise for both financial and industrial reasons, there was no easy way to meet it. This alone would have pushed prices higher. But it would not have caused a sudden break. The real trigger was the change in how large players behaved. Some countries began to reduce their dependence on global supply chains. They wanted materials closer to home. They wanted stockpiles. They wanted certainty. Some industries stopped trusting just-in-time delivery. They started paying more to secure long-term supply. And some financial institutions started to treat physical assets not as trades, but as insurance. All of this increased pressure on the physical silver market at the same time. At first, the paper system absorbed it. It always does. More contracts were created, more volume appeared. On screens, everything still looked normal, but underneath, inventories were shrinking. The moment of change came when this pressure could no longer be hidden by financial structures. When too many buyers want guaranteed delivery, the market is forced to choose between two things: price stability and honesty. It cannot keep both. The adjustment did not happen in a smooth line. It never does. Prices do not climb to new regimes. They jump there. One day, levels that had held for years simply stopped holding. Sellers disappeared. Buyers paid what they had to pay. This is how markets behave when they are no longer clearing on opinion, but on necessity. The move from $50 to $100 was not twice the enthusiasm. It was a change in logic. Below $50, silver was treated as a trade. Above $100, it was treated as a strategic resource. This is a very different kind of market. In parallel, something else was happening in the financial world. Confidence in long-term bonds was fading. Real yields were still negative in practical terms. Holding government debt no longer felt like safety. It felt like slow loss. This pushed even conservative capital to look for alternatives. Some went to gold, some went to commodities, some went to anything that could not be printed. And some went to silver, not because it was fashionable, but because it was small enough to move and important enough to matter. This is an important point. Silver is a relatively small market. It does not take much capital, in global terms, to change its price dramatically. This means that when large pools of money begin to treat it seriously, the impact is not gradual. It is violent. The price did not rise because everyone agreed it should be higher. It rose because enough people decided they could not risk not having it. This is how repricing events happen, not when optimism grows, but when fear changes form. Fear stopped expressing itself as selling risky assets. It started expressing itself as buying real ones. And when this shift reached the silver market, the old price structure could not survive. The event was not a single headline or a single crisis. It was the moment when years of pressure finally met a system that was built for a calmer world. From the outside, it looked like a rally. From the inside, it was an escape. When silver broke through $100, the most important effects did not appear in the silver market at all. They appeared everywhere else. Markets are connected by expectations. When one small but critical part of the system starts to behave differently, it forces everyone to question their assumptions. Silver had always been treated as a secondary asset, something that moved after gold, something that mattered mainly to traders and industrial buyers. It was never supposed to become a message. But that is exactly what it became. The first place this message was felt was in currencies. A currency is supposed to be a stable measure. When real things rise sharply in price, it means the measure is changing, not the thing being measured. Silver did not suddenly become twice as useful overnight. The units used to price it became less trustworthy. This is uncomfortable for policymakers, but markets understand it very well. When people see that an essential metal can double in price in a short time, they do not think silver is strong. They think money is weak. This kind of thinking does not stay in one place. It moves to other goods, other resources, other assets. This is how inflation changes from a problem into a mindset. The second place the impact was felt was in the bond market. For decades, bonds were treated as the safe center of the financial world. They were where serious money went to wait. They were where risk was supposed to disappear. But bonds only work when the value of money is stable. When real assets start to reprice upward, fixed payments in the future start to look smaller and smaller. Even if the interest rate is higher, the real value can still be falling. The move in silver made this problem harder to ignore. If an industrial metal is signaling currency weakness, then a long-term promise to pay in that currency becomes less attractive. This does not cause a crash overnight. It causes something slower and more dangerous. It causes quiet withdrawal, less demand, shorter maturities, higher risk premiums. This makes government financing more expensive and less predictable. The third place the effect appeared was in equities and speculative assets. At first, these markets often rise together with commodities. More money in the system lifts many prices. This creates the illusion that everything is fine. But there's a difference between assets that represent claims on a system and assets that exist outside it. Stocks, private companies, and even many digital assets depend on stable supply chains, stable financing, and stable consumers. When the cost of inputs becomes uncertain and the value of money becomes less reliable, planning becomes harder. Margins become less predictable. Long-term projects become riskier. In this environment, some companies benefit for a while. Others struggle quietly. The market becomes more divided. The move in silver did not say, buy everything real. It said, be careful what kind of risk you're actually holding. Then there is the business world itself. For many years, efficiency was the main goal. Keep inventories low, rely on global suppliers, optimize every cost, assume everything will arrive on time. That world was already under stress before silver moved. The repricing of a critical input only made the problem clearer. Businesses started to think differently. They started to care more about secure supply than cheapest supply, more about reliability than just-in-time delivery, more about balance sheet strength than short-term profit. This is not a small change. It is a change in operating philosophy. It means higher costs. It means more capital tied up in inventory. It means less dependence on distant systems. In other words, it means a less fragile, but also less efficient world. Finally, there's the psychological effect. When people see a quiet, ignored market suddenly become important, they begin to question what else they have been ignoring. Silver did not just reprice itself. It repriced attention. It forced investors and decision makers to look again at things they had assumed were stable. The most dangerous thing about this kind of change is not volatility. It is that old models stop working. Forecasts built on the last 20 years begin to fail. Strategies built on cheap money and smooth trade begin to look outdated. The move in silver is not the end of this process. It is one of the early signals. It suggests that the world is moving from a period where prices were mainly about growth and speculation to a period where prices are more about security and trust. This is not a normal cycle. In a normal cycle, things return to where they were. This is a shift in how value is judged. In such a world, many assets will still rise in price, but not all of them will rise in real value. And the difference between those two things will matter more than it has in a very long time. Silver was not the story, it was the warning.